Tuesday, April 21st, 2025. Before we dive on into this content, do me a favor and smash up that like button. And if you are not a subscriber, hit the subscribe button if you gain any value from this content. But first, let's start with Zhao Wedson. He says short-term holders have heavily distributed their Bitcoin over the past 7, 30, and 90 days. Usually when these metrics are deeply negative, it means the selling happened a while ago and the price tends to form bottom. I believe any new drop in Bitcoin should be seen as an opportunity to accumulate since short-term holders have already distributed. So if you were to click on these charts shared from Alpha Ractal, so give them a follow on X as well, you will see signs of distribution among short-term holders. I've said multiple times that short-term holders have more of an effect on Bitcoin's price than any other cohort. And if they are exiting distribution, then that is a good sign that 74 and change was at least a local bottom. I mean, we'll see about after. I shared charts last week talking about how short-term holders are now in the negative, which means that there's less likely to be selling from short-term holders. This is a good sign for a local bottom, and we'll see what comes after that. So see the next dip, whether it's 80K, 70K, or 60K, as an opportunity for the next priced rally. My buy orders are already set. So that's some interesting stuff there, some good stuff to start the video off with. Another thing here, this is from WW Bitcoin on X, the best account on X. If you don't know, it's my account. Okay, so it's really, really fascinating to see what's going on with crypto versus stocks right now. We have Bitcoin, even Ethereum, XRP, Litecoin, several other ones doing pretty well. They're doing pretty well, but then the S&P 500, the NASDAQ, the Russell 2000, a lot of stocks like the Magnificent Seven, as of the day that I'm making this video, they're still bleeding and it looks rough. And so here's what happens whenever we see something like this play itself out, is that somebody is going to call for finally the big decoupling, because there's a significant correlation between price movements with crypto and with stocks. In this idea that stocks would do poorly and crypto would do well, it's just not something that's really ever been taken seriously over the last several years, over the entirety of Bitcoin's existence. And so the idea that now would be the time, that seems like a sort of wishful thinking, and that crypto is just going to follow stocks, or maybe stocks are going to follow crypto and rebound here. But the next thing I'm going to share with you is an interesting perspective into the global shift that is happening right now. And so are we decoupling? Are we actually decoupling? It's kind of reputational suicide to suggest such a thing, but here we go. This is from Fei Zhao, Fejau. Sorry for mispronouncing your name. Don't know what that means, but Bitcoin, the trade after the trade. This is an article that has been posted on X. Now, I'm not going to share everything from this article, but I do want to share a few charts and then just generally share his thesis statement from this article, which, decomposition of systematic influences on Bitcoin. We have global liquidity, we have investor risk appetite, gold Bitcoin ratio, and gold price. Those are major influences in Bitcoin's price. And so some things that we've seen here is he's trying to analyze the effects of the tariffs, not from a perspective of injecting his own opinion here, but from a perspective of what's going to happen as a result of this. And the general gist of it is that the United States has been operating at more of a deficit over the last several years than every other major country that's in play here. Let me pull up this chart, and you can see, the trend and the selection. We have Canada, United States, Germany, United Kingdom, Mexico, Korea, Japan, Italy, and France. The trend from 1990 to 2029, and you can see United States has consistently been on the bottom, but right now we are trending down, and we are the lowest out of every country, negative 7.32% of GDP. And so what has the positive of that is, as we have seen over the last several decades here, a heavy investment in treasuries and in the United States economy, we have seen the prices of United States assets increasing dramatically in comparison to foreign assets. What this article speculates, where did that go? Okay, what this article speculates is that as a result of the tariffs, there's going to be a lot more infrastructure building and defense building in other countries. And there's going to be a lot of other things that are going to make investing in other countries more favorable and seeing more growth in foreign indices over the United States. So there's going to be an outperformance of foreign indices over the United States. But there's an acknowledgement that there is some risk and some red tape that is not going to be interesting for some people when making those investments. And so, yes, an increase in investment in foreign indices, but a desire, a mentality of, all right, we want to, by and large, invest in things that are easier to invest in, that have a global reach. And so what are those two things? What are those things from the conclusion of this article? Those two things are gold and Bitcoin. So we're seeing right now the effects of investment in gold as a sort of fleeing, but as more so a sort of wanting to diversify outside of the United States. And we've seen China buy a lot of gold recently, and we're seeing the price of gold go parabolic. And I'm going to tell you, I think that, there's short term, there can be a correction in the price of gold, but I am very bullish on gold for the remainder of this decade, for the next 10 years or so. And I think we're only at the beginning. And sure, short term, what can happen is, gold can correct, but personally, I'm thinking $10,000 an ounce gold within the next 10 years. But then after that, this is the title of this article, The Trade After the Trade. So what is the trade? Right now, the trade is gold. The trade, as we're seeing this shift, that was inevitable, I'm telling you, this shift in the way that the global markets are functioning. With the results of that shift, we're seeing gold kind of take center stage right now. And what is the trade after that trade? The trade is Bitcoin. And so after we see, and we've seen plenty of charts that people have shown you from Moon Boys saying that Bitcoin is going to skyrocket after we see distribution in gold. Well, this is an article making a more eloquent case for that. I just want to remind you that that takes several months to play itself out. It's not like gold is going to end this run tomorrow and then Bitcoin the day after is going to skyrocket. But, we're on gold's timeline right now. And once that distribution in gold, a short-term distribution, plays itself out, Bitcoin is going to look very attractive. What's the time frame? It could be a month, it could be 6 months, it could be a year. And speaking of that, check out this article, by the way. It's a very informative article. I thought I was going to share more bullet points, but I ended up not doing that. But, all right, speaking of a longer timeline than what I think a lot of people are suggesting here, we have Virtual Bacon, very well known, well followed, very smart guy on X, on TikTok, on YouTube. And here's finally they're catching up. They're catching up to me. I hate to say it like that, but it's true. They are catching up to me because I've been saying this for quite a while. I'm adjusting my bull market exit strategy. Number one, Bitcoin target, still $200,000, but likely not this year, possibly 2026. Has anyone been telling you that? For well over a year now. Yes, someone has. This guy right here, WW Bitcoin on X. Hit the follow. 2, liquidity cycle may extend into mid-2026. Has anyone been saying that for well over a year now? Okay, let me get off my high horse. 3, exit trigger now based on Bitcoin losing the 50-week moving average, not the 21-week EMA, which is another thing that I have been saying. If you've seen this on my X account or on my short form videos, I've talked about the 50-week moving average being the last line in the sand. And if we lose that, then we're probably going to be going lower for several months, and it's going to take a while for us to recover from that. And then 2026 would look like 2023. So we lose the 50-week moving average, it's going to be over for a while, but we're still above it. 50-week moving average is around $76,000. And yeah, we did lose that on a wick, but we did not lose that on a weekly candle, not yet. So finally, they are catching up, but more volatility, longer cycle, so hold longer. Sure. I am of the mindset that the all-time high for this cycle is going to be closer to the next halving in 2028 than the previous halving in 2024. That essentially means that Bitcoin would peak after April of 2026. I am quite convinced of that. whether it's in late 2026 or mid 2027, whatever, at any point in 2027, I do not believe that 108 was the peak, but I'm of the mindset that we could go much lower than where we are right now in between now and then. All right, moving on. 4 years ago today, do you remember NFTs? I'm joking about that, but 4 years ago today, someone bought this JPEG for $69 million. Oh my goodness. And it's worth about $19,000 now. It's still overvalued by about $19,000. My goodness, the 2021, what a year that was. I mean, not as exciting as 2017 going into early 2018, but the excess of 2021, I'm very curious to see what this looks like when, historians look back at the NFT craze, if they're going to look at it in any way similar to what most of us in the moment were thinking, right? It's not like any of us ever thought this was actually worth $69 million. But moving on. So some economic stuff. Again, I hate to say it again. I am of this mindset that we are in a recession now, but I've been of this mindset that we were going to enter a recession in 2025. And the trigger for that was the first rate cuts. It had nothing to do with tariffs. It had nothing to do with who's president. We were going to enter a recession in 2025. If Kamala won and they defined it as something else, like they defined it in 2022 as not a recession, whatever the case, it is a recession. A recession being at least 2 quarters of negative GDP. So here's another thing, another thing to pay attention to. Housing supply hits 5-year high. Active listings, the total number of homes for sale, hit the highest level in 5 years in March. They climbed 0.1% month over month on a seasonally adjusted basis and 14.1% year over year. So, I mean, look, sure, in 2012, 2013, 14, 15, 16, et cetera, there were more houses for sale, but over the last 5 years, we are at a point where there's a lot more housing for sale. And why is that? Well, and maybe it's some people being desperate, because, a lot of these people, they locked in very low interest rates in 2021, or maybe it's something else. I've heard of something that's going on. I have not been able to verify this, so take it for what it's worth, that there's a lot of FHA loans that are underwater right now, but for some reason, the powers that be are not letting those homes being, to be for sale or foreclosed or anything like that. And so whatever that means, it may be that there's actually a lot more houses that should be on the market that are not. But anyway, moving on. Another fear with recessionary stuff. All right, I'm bullish on Bitcoin at the moment, and maybe we're in the middle of a potential decoupling from the stock market. This is more medium term. This is more 2025. My bullishness on Bitcoin in terms of a potential decoupling extends well beyond 2025. So, all right, Daniel DiMartino Booth, not sure if folks appreciate how rapidly the recession is deepening and spreading. I say this not to be gloomy, but because days like today serve as reminders to prepare to be generous to our family members and friends, and as kind and charitable as we can be to our neighbors. You never know. That's just kind of a fear-mongering tweet here. But anyway, Craig Fuller, domestic freight out of LA is at the weakest level, seasonally adjusted, it has been since 2020. Up till now, the Liberation Day tariffs have not been a factor in declining volumes out of SoCal. It's going to get worse. So this chart right here, it's probably going to need some explanation from me. I was confused when I first saw this, because I was looking at these lines here and like, oh my goodness, look at this dump here. That's not what we're looking at. It's actually where the circle is, which obviously maybe you should be paying attention to where the circle is. So the blue line is 2020 outbound traffic out of LAX in 2020. The white line is where we are now. So every year other than 2020, you can see outbound traffic out of LAX, a sign of, people have some income to spend to travel to different places. It's lower than any other year aside from 2020, and it's deepening rapidly. And the point that's kind of alarming to me from Craig Fuller is this is not factored in anything since Liberation Day tariffs. It's been 3 weeks, less than 3 weeks. And so here we are. What's this chart going to look like after we see some short-term effects of Liberation Day tariffs? Another sign that we are currently in a recession. But moving on, this is not as much recessionary stuff as much as it is just I'm a fiscal libertarian and I can't stand government excess. And so I had no idea. If you live in the state of New York and you can verify this, please let me know. Just consider the New York State Medicaid funded program for paying people to stay at home with aging relatives. Back in 2014, only 20,000 people were paid by the program. When eligibility rules changed in 2015 during the outgoing Obama administration, the number jumped to 250,000. Today, the figure is more than 620,000 people. This taxpayer-funded program now makes up 12% of New York City's private sector jobs, according to Bloomberg. 12% of people who live in New York City are being paid to stay home and take care of an aging relative. And what does that even mean? Okay, could it be that there are people who need care and they have relatives genuinely caring for them? Or could it be that grandma who's 80 years old and fully able is being taken care of by a family member? I'm very skeptical of this, and I can't stand stuff like this. This is why, Trump's going to get a lot of hate. Department of Government Efficiency, as of right now, seems to be not living up to the hopes that I, as a fiscal libertarian, had hopes for, or whatever. But something needed to be done, and things still need to be done. And I've always known that whoever was going to be the first one to do those things was going to face quite a fire. So this is insane. It's ridiculous. But moving on. So the Kobesi letter. Given the recent sell-off in treasuries, who effectively owns U.S. public debt? The largest holders of treasuries are foreigners who own $8.5 trillion, or 33% of the total. Japan. A lot of people think China is the top holder of U.S. treasuries. It's actually Japan. Japan is the top foreign owner of $1.08 trillion of U.S. government bonds. China is the second largest foreign holder and owns circa $760 billion. 31%, or $8 trillion, is held by the financial sector, including banks, mutual funds, and hedge funds. The government and households own 24% and 11% of the treasury market, respectively. Foreign holdings of U.S. treasuries are huge. So where do we have? Rest of the world, ROW, we have 33%. You can see there. It is not as significant as it was in 2010. It's narrowing. I guess that's a good thing. We don't want to have what we had, with a lot of dumping of treasuries from Japan and China, but it's still significant. Households, 11%. Don't really understand as of right now why anyone would have treasuries, considering the fact that the real rate of inflation is higher than the rate of return you're getting with treasuries. But not something I'm interested in. Financial sector, government, 31%, 24% respectively. And the reason why I share this is I've talked about this a little bit on this channel. This is perhaps if there's anything that's going to keep me up at night in fear, and I get pretty dark about what the future looks like. Just some perspective. This is the 10-year yield since 1963 on this chart. So this is spanning back several decades, and what you can see is that we've been able to get away with consistently over a period since about 1981 of having lower highs and lower lows in the 10-year yield. And what we're seeing recently is a sign of what? A sign of this funny money experience being over, a sign of loss of faith in the US dollar. It should not be a surprise at all to you that this occurred after the great debasement of 2020, where we saw M2 money supply skyrocket. And personally, that was a turning point for me in my understanding and in my desire to have as few dollars in the bank as possible. And so is it even within the realm of possibility that we would be able to see this get back down to zero, which I don't know the answer to that. If the answer is no, then the interest on our national debt is a huge, huge threat. There are two ways that we could get this back down. That is through confident investing in treasuries from foreign countries around the world. That seems unlikely to me. Or from domestic, from companies in the United States, from banks in the United States. That's option number one, which I find to be pretty unlikely. Option number two is printing of money to an extent that it would make 2020 in 2021 look pretty tame, to where the Federal Reserve does easing to a level that we've never seen before, like $10 trillion. I don't want to say tens of trillions of dollars, but perhaps $10 trillion, in that they're buying treasuries. They're buying treasuries at insane clips to bring this down. But then what comes after that is just boom, right back up, even higher levels of inflation. I am really nervous about this. It's just something that you've got to keep in mind. This is not good. Now, personally, as a fiscal libertarian, I would love to just see the market reset itself, but I'm telling you, that's going to bring a lot of short-term pain. And I don't know if we're prepared for that. I don't know if I know for sure that the general American public is not prepared for that. Okay, Darth Powell, Vlad the Inflator. Housing market is done. Biblical crash is coming. All right. That's a little, what's it called? I'm not saying that I'm endorsing that statement, okay, that the housing market is done, that a biblical crash is coming. But the thing about this chart that really sticks out to me is real mortgage payment price index. You can see that we are at a level not seen since July of 2006. If you remember, there was a Time magazine cover. It was either from June or July of 2026, and that cover was the peak of the housing bubble. That was the peak of the housing bubble. A cartoon of a guy holding his house, how wonderful of an investment his house was, and that was the peak. That tends to happen where we see magazine covers being the peak. Now here we have October of 2023, that was the peak of affordability. And so what Darth Powell is making the claim of is that from here, we have a housing crash of epic proportions. My counter argument to that would be, I think that a lot of people are just going to stay in their homes, especially they got the bottom of these amazing interest rates in 2021, where we saw interest rates go down below 3% on a 30-year loan. Those days, I have a hard time believing that we're going to see that happen again anytime soon. So we'll see, but that is an interesting chart to me, really fascinating. I didn't actually click on this, but let's see. Charlie Biello, do I follow him? Yes, I do. Okay. Monthly mortgage payment needed to buy the median-priced home in the United States for sale. April 2020, $1,484, $1,688 in 2021, $2,404 in 2022, $2,555 in 2023, $2,750. My goodness. In 2024, 2810 in 2025. That's an 89% increase over the last 5 years. Perhaps we're having a rounded top here. Ay. All right. Now, hey, how about some positive news? And this is the last thing that I'm going to talk about from X. Wise words from Peter Lynch may be timely as well, considering the mountain of worry. Good luck out there. Here's the words from Peter Lynch. The key to making money in stocks is to not get scared out of them. Peter Lynch. S&P 500 flows into money market and cash ETFs 3 months rolling. And so what is this communicating to you? This is when people in the stock market tend to flee to safety. What happens is when there's a dump, that is when they flee to safety. Okay, we saw that in 2018. That was very high in 2018. We saw that post-COVID crash. A lot of money flows into money markets and cash ETFs. We saw that at the most scary points in 2022 during that so-called non-recession, and here we are again, lots of flowing into money market and cash ETFs. Almost as high as 2022, so maybe this is a time to be buying. Seems like it makes sense. Good luck if that's your perspective. The difference I would say between now and 2018 is, there's a potential that this could be a reckoning of more significant sorts, but it is what it is. Maybe this is the perfect time to buy. I do acknowledge that might be the case. But anyway, so Bitcoin, $88,000 as of the moment that I'm making this video. It is right up against the 200-day simple moving average. I tend to think that it's not just going to cut through that like butter. I don't think that this is a time to FOMO in to Bitcoin at the moment that I'm making this video. We'll see. We'll see. I am curious to see what we have with the Dow Jones, because in the morning, as of the day that I'm making this video, the Dow Jones was down pretty bad, and it looks like it's still down pretty bad. So, decoupling. Is this the time of the decoupling? NASDAQ, S&P are down. Bitcoin is up. Ethereum doing all right, $1,636. XRP, $2.13. Solana, $139. And so as I'm looking at these prices and as I've known where those prices were, I would not be surprised if Bitcoin dominance is climbing higher. Okay, Bitcoin dominance is climbing higher. I tend to think that Bitcoin is a better play right now until we see a new all-time high for Bitcoin. Hopefully sooner rather than later. That's just my perspective, but we will see. So anyway, that's all I have for today. I hope you have a wonderful day, a wonderful rest of your week, and I will most certainly be seeing you in another video. Peace.